Right, hi guys. Here we go again. I'm going to do a quick video here and I hope it's helpful. It is going to move quite fast and I'm going to cover a fair few things, which I hope is easy enough to follow based on what we discussed earlier. You see in the Discord, I posted a couple of pictures showing a trend and another picture showing, or one picture with the trend and another one showing the candlesticks. So as I said, candlestick shows four things. The open, so that's by the open, that's what I mean on a weekly bar is at the start of the week, the price at the start of the week, the close at the end of the week, the highest point it reached and the lowest point it reached in that week. Something we'll come on to in time is the opening sessions for each day and the opening times for each week are quite significant as well. The price that was at the open is something we can use as a reference point. It seems to be a bit magnetic for traders. So again, these levels, each of them, open, high, low, and close, they all have significance. Hence why a candlestick is so useful, because it's a brilliant graphical display of those four things. So we talked about trend briefly, and my main point was that trend can look one thing on the higher time frame, but offer both directions and sideways on the lower time frames. And the one candlestick on the weekly chart hides an incredible amount of action on the lower time frames, going down right to the 4 hour, 1 hour, 15 minute, 5 minute, 1 minute, whatever you choose to do. So on the screen at the moment, I've got two charts side by side. They're the same chart, but different time frames. On the right hand side is the euro dollar. Hang on a sec, let me maximize the screen a bit more. There we go. On the right hand side is the euro dollar weekly chart. And in the right hand tip, on the right side of that chart is the current weekly bar and the one before. This is what we were looking at earlier. On the left hand side of the chart, you'll see this again. This is the 4 hour now, and you can see a lot more has been going on in this really quite rapid move up for the euro. And we'll have a little look at that move up and why it's happened as well at the end of this. So that's the current bars. I've also highlighted this big section on the right, which is an upward move on the weekly chart within a bigger and broader downward trend. Now, an upward move on the weekly chart offers huge amount of options on the 4 hour chart. If we snap to that on the 4 hour chart on the left, you'll see quite how much action was contained in those moves on the weekly chart. And honestly, there's a lot of chance for sells and a lot of chance for buys in those weeks. And that was just a corrective upward move within this broader downward move. So trends within trends, that's really the thing. And there are, of course, sideways periods as well. You could argue, if I change this box on the right, you could argue that this area is a sideways consolidation, very much so. Even though it was overall moving higher, we have a very good sideways bit of action. And in fact, some really good trades come out of the fact that we have a sideways range, as we call it, a range, prices ranging, and then prices spiking out of the range, but coming back within it. This is something Murray and I touched on, where I described how the market fakes its participants, as in you and me and the retail traders, as we're called. So lots of stuff there, but basically, in a nutshell, the market can only go up, down, or sideways. All we've got to do is figure out what it's doing and then look for the clues. Simple, right? So the next thing I want to talk about is liquidity. I've talked about liquidity with Mara briefly. We should go over this again and again and again, because liquidity is probably the key thing I'm going to teach, and it's what I use. And it really is so important to understand, because that is what drives the market. Liquidity is where the orders sit. I described the big boys trying to enter the market at big positions. They need to enter. Let's say they want to put in a trade a size of $1 million, which is probably peanuts for them. I don't know the details, but if they want to sell that many orders, let's say they want to sell the euro and buy the dollar, so they want to sell the euro against the dollar, they need to get rid of a lot of euros. So they need to find what we call liquidity pools in the market, which is places or prices at which, if they want to sell the euro, there are going to be enough people who want to buy it that they can fill their orders. Because in trading, if you want to sell something, there has to be a buyer on the other side. So they need the pool of buyers in order to be able to fill their sells. That's the basic. And the opposite obviously is true. If they want to buy, they need a pool of sellers who are going to swallow up their buy orders. And the other thing, as I described, is that the marketplace for these big institutions, let's go back to the selling model. They want to sell the market. They need to find, and hang on one sec, guys, I've just got to pause it.